It's 7:44. Over half the country implemented higher minimum wages over the last year at a time when many people are paying higher prices for groceries and other items. Gerrod Galliano with Burns Estate Planning and Wealth Advisors joins us now to talk about kind of the give and take over a higher minimum wage. Good morning to you.
Yeah, good morning.
So 27 states have done it. You know, if you were making $12 an hour and working hard and you're having trouble buying eggs for the family, it's understandable why people would want to see a higher minimum wage.
Look, absolutely. And first off, it's normal and healthy for a couple of states a year to have a little increase in minimum wage and also to have some inflation. But when 27 do it at the same time, at a time of record inflation, well, yeah, something's probably broken.
Because on the one hand, it does certainly help individuals cope for at least a period of time, but your point is it can be inflationary?
Yeah, absolutely. Look, the good news is workers need the help. It feels good for them on the surface. It's a nice thing to increase the wage. On the opposite end, you say, well, these businesses now have to pay more for the workers at a time where everything costs more anyway. So it's going to cost a little extra for everything once again, which increases inflation.
What kind of an effect does it have? And it's funny, I want to delve into the effect on the labor market and how also this labor market might be a little bit different. But the traditional sort of economics argument is that if you raise the minimum wage, you lose jobs.
Yeah, absolutely. So it's a double-edged sword. Think about going to the store. There used to be 10 lanes, cashiers in every one. Now you've got around 2. Look at the self-checkout. So I think more long-term thoughts about more technology replacing workers, less benefits. And there's even studies that say every dollar you raise the minimum wage, the workers net around a $1,500 loss because of the loss in hours, the loss in benefits, and bonuses.
And I think that's certainly sort of been kind of the conventional wisdom. I do wonder at a time when we have 3.5% inflation, or excuse me, unemployment, 3.5% unemployment.
Right.
The labor market, despite all these pressures, remains pretty strong. So is it possible that the labor department or labor market can take a little more than normal?
Yeah, absolutely. Look, the labor market is strong. We're more concerned with, looking at growth of companies, looking at confidence in the economy, and just adding on another cost, adding on another piece that's going to say, okay, everything's a little more expensive now.
We're down to 6.5% inflation, which sounds great. Prices double every 11 years. That's 6.5% inflation. Sure. So in that sense, we still need to bring that inflation rate down. What's the effect on the market, and do the markets thrive until we get it down?
Look, we're absolutely looking at this because look at your tech market, your NASDAQs, your Amazons, your Apples. These are all growth oriented. It's harder for them to borrow money in the short term to get the growth they need, to get the returns they need for people to have investment confidence. So as long as inflation's high, rates are high, they're going to struggle. So everyone's looking for that vote of confidence that they're going to slow down the raising of rates so these companies can take off again and get the growth they need.
We'll be looking for that. Gerrod Galliano, thanks very much for the time this morning.
Hey, thanks for having me.